The stochastic oscillator is a popular momentum indicator in technical analysis that helps traders understand overbought or oversold conditions in the market. The stochastic oscillator is based on the following formula. %K line is the main line of the stochastic oscillator and is typically displayed on a scale of 0 to 100. The D line is the moving average of the K line, often a 3-period simple moving average of K. The indicator oscillates between 0 and 100. Values above 80 are generally considered overbought, while values below 20 are considered oversold. When the %K line crosses above 80, the market is considered overbought, and a reversal to the downside may be imminent. Conversely, when the %K line crosses below 20, the market is considered oversold, and a reversal to the upside may occur. A buy signal is generated when the %K line crosses above the %D line, and a sell signal is generated when the %K line crosses below the %D line. Divergence between the price and the stochastic oscillator can signal potential reversals. For example, if the price makes a new high but the stochastic oscillator does not, it may indicate a weakening uptrend. Traders often use the stochastic oscillator in conjunction with other indicators to confirm the strength and direction of a trend. Imagine you're trading a stock that has been in a prolonged uptrend. If the stochastic oscillator moves above 80, it indicates that the stock might be overbought, suggesting you might want to prepare for a potential pullback. If, during a downtrend, the oscillator moves below 20, it suggests the stock might be oversold, indicating a potential buying opportunity.